Over the years, understanding market structure and its components have helped some traders become profitable in different assets in the financial markets. Today, we talk about this. When the market price of an asset is on an uptrend, it most times creates series of higher highs and higher lows. And when the market price of an asset is on a downtrend, it most times creates series of lower highs and lower lows. Uptrend is represented by higher highs and higher lows, while downtrend is represented by lower highs and lower lows. On an uptrend, when the market price is making series of higher highs, it is in that process breaking previous highs, that is, breaking previous market structure, which is called break of market structure, in short, BoS. And on a downtrend, when the market price is making series of lower lows, it is in that process breaking previous lows, that is, breaking previous market structure, which is, as earlier said, called break of market structure. An asset's market price is capable of changing its structure from an uptrend to a downtrend, and a downtrend to an uptrend. This process is called change of character, in short, CHoCH. The process is also called shift in market structure. On an uptrend, change of character, or shift in market structure, occurs when the market, after making a higher high, comes downward, and then breaks through the previous higher low. If the market created an order block, or an imbalance just before it broke the previous higher low, there is a high probability that the market price will go back upwards to tap into that order block, or imbalance before going downwards fully, that is, before starting a downtrend, either for a short time, or for a long time, by creating series of lower highs and lower lows. On a downtrend, change of character, or shift in market structure, occurs when the market, after making a lower low, goes upward, and then breaks through the previous lower high. If the market created an order block, or an imbalance just before it broke the previous lower high, there is a high probability that the market price will go back downwards to tap into that order block, or imbalance before going upwards fully, that is, before starting an uptrend, either for a short time, or for a long time, by creating series of higher highs and higher lows. Order blocks are short candlesticks, or an order block is a short candlestick, overshadowed by one long candlestick, in respect to the candle size at that moment, before a move occurs either to the upside or downside. These are order block formations. One short candlestick, overshadowed by a long candlestick. Two short candlesticks, overshadowed by a long candlestick. And just so you know, it could be more than two short candlesticks, overshadowed by a long candlestick. Note: all these are in respect to candlestick size at a moment on a chart. Because on your chart, you could see a long candlestick, overshadowed by a very long candlestick. That long candlestick, that is overshadowed, can be regarded as short, in respect to candlestick size, at that moment. This is how to zone order blocks, or mark order blocks. It is important to note that, one of the things that makes an order block valid is, it has to break structure, that is, it has to break a significant high or low. If the move that emanates from an order block breaks a significant high or low, the market price is most likely going to return to tap into that order block zone, before it continues moving in the direction of the break of structure. Real-life example of order block zoning, and how it works. You can see how price respected the order block zones. If you look at these areas, you would see the move that emanated from the order blocks did break structure. Imbalance between candlesticks is also known as inefficiency, or fair value gap, in short, FVG. An imbalance in market structure is the gap between two opposite candlesticks. This is an imbalance formation. You can see three candlesticks, one at the center, one at the left, and one at the right. Marking the left candlestick's wick and the right candlestick's wick, you will clearly see a gap. That gap is called an imbalance, or fair value gap, or inefficiency. Market price most, or sometimes react to it, like it does for order blocks. Also, market price is drawn to imbalance gaps because of its need to balance structure. When market price leaves imbalance gaps while moving upwards or downwards with great momentum, it most times come back to fill it, to obtain balance in structure. It might take time, but it eventually does. Market price is also drawn to order blocks somehow. Here, you can see imbalance in many places, and how the market price filled them all. You can see how price reacted after filling the imbalance zones. Important educational trading videos have been uploaded in this YouTube channel. You can form your own strategy from the educational trading videos dropped so far, and by constantly being on the chart, on demo, practicing. You can also do more research on the topics touched so far, for better understanding. Thanks for watching. Subscribe to this YouTube channel, turn on the notification bell, and wait for more updates. If today was the last day of your life, how exactly would you be prepared for eternity?
Jesus said, "Take heed therefore that the light which is in thee be not darkness." When a room is dark, you use light to find your way. The light helps you to locate your path, your direction, and you don't stumble. But Jesus is saying, be careful so that what directs your path in life is not an evil desire. That's what it means for light to be darkness. Be careful lest what define your choices, what determine your decisions are evil desires. You see, every day you are going to make decisions, you're going to make choices. But what is driving all that? If it is an evil desire, at the end of it, sin is produced, which will, among every other consequence, attract an eternal punishment at the end of your life.
Glory to Jehovah God Almighty. Elion. Up switch tick.